If someone has a structurally bullish view on gold, especially more than energy, if they think gold's going to 10,000 while oil stays, 150 or less, then probably miners still have room to run in the years ahead leading up to that view. But if someone thinks gold chops around at 4 to 5K for quite a while and energy chops along, then maybe miners chop along as well. I wouldn't call them expensive. I just think there's quite a bit of risk there. Some of the asymmetry's gone.
We now, to everyone's surprise, they say, God, we didn't realize a third of the world's fertilizer comes through the strait. 20% of the oil. I think about 50% of the helium. We have a huge amount of aluminum. All kinds of other things coming through there. So it is, from an economic point of view, very significant. Now, whether the value, my guess is, and this is without, doing due diligence, my guess is your assertion is probably correct. It's probably a lot more value goes through the Strait of Hormuz than the Bosphorus.
Gold, energy, and currency stability are moving back to the center of the global macro conversation. When inflation pressures remain elevated and geopolitical risk rises, investors start reassessing where real protection can be found. That is why gold, miners, and hard assets are attracting renewed attention. Steve Hanke, a veteran economist known for his currency and inflation analysis, and Lyn Alden, a respected macro strategist focused on liquidity and monetary systems, explain that the next phase may depend less on headlines and more on relative pricing. If gold continues climbing while energy costs stay contained, mining companies could still have upside ahead. But if gold stalls in a broad range while oil and input costs remain high, many miners may struggle to expand margins. They also highlight how dollar demand remains strong globally, especially through new digital channels that make holding dollar-linked assets easier. If monetary imbalances continue building, capital may increasingly rotate towards scarce assets like gold. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
So I have a similar view, which is that years ago I was very bullish. I viewed that there's a ton of asymmetry. As you've seen this kind of sharp rise in gold and silver, we had eventually, with a lag, we had a sharp rise in the miners. I at that point trimmed my GDX position. I'm still long in some portfolios, but it's I've kind of used the opportunity to rebalance and right size those types of positions. Prior to this conflict. So obviously miners, they mine gold, and a big chunk of their expenses is energy. Not all of it, but a big chunk of it. And so prior to the war, when you have a sharply rising gold price, but pretty cheap energy, all else being equal, that's pretty good for miners. But then when you risk an energy crisis, and when gold eventually stops going up, that obviously challenges some of the assumptions. If someone has a structurally bullish view on gold, especially more than energy, if they think gold's going to 10,000 while oil stays, 150 or less, then probably miners still have room to run in the years ahead leading up to that view. But if someone thinks gold chops around at 4 to 5K for quite a while and energy chops along, then maybe miners chop along as well. I wouldn't call them expensive. I just think there's quite a bit of risk there. Some of the asymmetry's gone. So I kind of made the decision to kind of leave that space a little bit more to people who focus on it. So I rode what I viewed as the more macro portion of that, which is you buy a generational bottom in miners, you let it run for a long time. Inevitable things tend to take a little longer than you think. So you wait a little longer than I thought. It eventually soared, got multiples. And now I have a less convicted view because we've already had a big run. And I leave that more to specialists that can go stock by stock, find all the undervalued ones, find the ones with good geology, good jurisdictions, good value for the risks and the opportunities that they have, good management. So I think there's still opportunity in the space. I just think you have to be careful. The market cap keeps growing because people want dollars, and it's kind of like a stablecoin compresses the overhead cost of having an offshore bank account. Anyone with a smartphone now has the equivalent of an offshore bank account with stablecoins. Downside, of course, is that because they're centralized, they can be sanctioned at any time. But if you're in a country where it's not a risk and you want dollars for working capital, those are useful. It's a useful technology. Tokenized gold has been around since at least 2018. There's Paxos Gold, there's Tether Gold. Back in I think it was 2020, it was like 2020, 2021. I owned some. So I mean that's useful. It's kind of like how, for a similar reason that some people want gold ETFs. I mean they're not a replacement for physical gold in your own custody, but for certain pools of capital, they might want that. And the cool thing about tokenized gold is it's not tied to one jurisdiction. You can bring that around with you rather than it being just tied to, say, the American financial ecosystem or something. So I do think that tokenized gold is a valuable thing. I'm a venture investor in the space. I mean, one of our companies tokenizes assets, including securities, equities, to make them more available to the world, right? So it's pretty easy to buy stocks, American stocks, if you're in America. It's not that hard if you're in kind of another developed country. It's a little bit harder if you're in a developing country. And so tokenizing equities or tokenizing attractive securities can make them more accessible, can make them trade 24/7.
The big problem with the press is Hanke's 95% rule. 95% of what's in the media is either wrong or irrelevant. So there is a convention, a very famous one actually, and there was a lot of back and forth for almost 35 years with what was going to happen with the Dardanelles, and Turkey had originally, of course, the British were very involved with the thing, as they often are. They were attacking basically the Ottoman Empire, and they wanted Turkey out of the thing completely, with nothing to do with it. And the final resolution was the Montreux Convention, and so that is the precedent. This is what you and I are kind of grappling with here. If you go to war with somebody, or you take any kind of action, as an economist, you want to look at the benefits and cost. And any logical decision, whether it's economic or non-economic, you look at the benefits and costs and try to tally them up. The costs are clearly something that the Trump administration never looked at. They don't even know. They don't even know. The director of the Office of Management and Budget, testifying this week, said he had no idea what the bottom line cost would be in a budget. That isn't all these external costs being imposed on everybody because of high oil prices, high helium prices, shortages, aluminum, you name it, everything coming through the Strait of Hormuz. That doesn't include that. It's a little bit of a charade in the sense that where is this thing all written down? Who's agreed to what? It's a little like the tariffs that get thrown up all the time. The president announces a tariff agreement. Well, nothing is written down, and no one knows really what's been agreed to, and then the verbal agreement is often changed, whatever it happens to be. But you have to realize, Mario, it's kind of in business and finance what they have, which we don't know exactly what it is, and in fact, as you know, the original thing that came out of Islamabad, the Pakistanis said, well, it included Lebanon, was in the agreement, and then the U.S. and Israel said, well, Lebanon wasn't in the agreement.
Yeah.
Well, now they've come to some kind of agreement, whatever that happens to be, with regard to Lebanon. But these agreements, in this particular one, where they said, well, if we come to a temporary agreement, then there'll be a 60-day period, a window of 60 days before some final thing is agreed to. So the starting agreement, if it was actually a real agreement, would be like a memorandum of understanding in the corporate world. And everyone knows that those aren't worth the paper they're printed on. Memorandums of understanding are broken
not legally binding
all the time. They're not legally binding and always broken. Remember also that we have a big spoiler in the game, and that's Israel. And Israel has a propensity to break all these agreements and basically do whatever they want to, because they're operating in a state of anomie, of lawlessness. So whatever the U.S. agrees to with Iran probably won't come over the finish line in that 60-day period, because there'll be a high probability of sabotage of that by Israel. But even if it does go over the finish line, I think it's going to be shall we say, a tenuous agreement. Plus the fact 60 days, Mario, let's put this thing, when you listen to Trump, you have a situation where listening to somebody who's rambling, incoherent, and delusional most of the time. So it's a little hard to get a grasp on reality. And according to the president, it's over. It's a done deal, and that's the end of it. And that's what the markets have reacted to. And then we've got this 60-day period before it's really over, signed, sealed, and delivered, and so forth. To put that into context, you know how long it took Henry Kissinger to negotiate the end of the Vietnam War? 4 years. He was commuting to Paris and the Hotel Lutetia in Paris for 4 years.
The deeper message is about asymmetry. Earlier in the cycle, many mining stocks were deeply undervalued, offering strong upside if gold moved higher. After a major run, that easy opportunity may be gone, meaning investors now need to be more selective. Instead of buying the entire sector blindly, focus may shift toward companies with stronger management teams, better jurisdictions, lower production costs, and healthier balance sheets. In other words, the broad macro trade may be transitioning into a specialist's market. Another important factor is energy. Mining profits depend heavily on fuel and operating costs. Even if gold rises, sharply higher oil prices can reduce margins. That means future winners may be businesses that can manage costs efficiently while still benefiting from stronger metal prices. The next leg higher may reward discipline more than excitement, and fundamentals more than momentum. Let's get back to the interview.
There's already in kind of a local bubble territory. So I've been on the record that I don't think it's fundamentally overvalued, gold and silver. I think it was a repricing from being undervalued to closer to something approximating fair value. But when you move that quickly, sentiment can rise very sharply. A lot of fast money can go into the space, and fast money can go out of the space quickly too when there's a risk-off situation, when that money's kind of better elsewhere. And so the problem is something is often not a safe haven when it's tripled in price in a short period of time. And I think that's the biggest challenge. I mean, people are saying it's no longer a safe haven. I disagree with that. I just think, again, when things go up that quickly, they can go down pretty sharply. I think even in a prior conversation, you were asking me about $100 silver. It was back before, I think we were at like, say, $60 silver, and you're like, could it go to 100? I'm like, it could, absolutely. But it can also, I wouldn't be shocked if it goes to 100. I wouldn't be shocked if it goes to 40 first, right? I was like, it's like, I had a very firm bullish view on silver when it was like 17 an ounce. But once it's gone up multiples, it's not that I think it's overvalued. It's just that the asymmetry's gone. With silver, we end up we soared, and then we had some of the biggest sell-offs like ever, and then stabilized. And that's the risk when you've had such a strong upward move. And gold, less extreme, but a similar thing. And then people also wondered, well, okay, why didn't Bitcoin sell off? It's usually a risk-on asset. Why didn't it sell off amid the crisis? It's like, well, it already had the opposite problem. It already sold off a ton in late 2025 and early 2026. All that fast money is already out of this ecosystem. The coins are held by pretty strong hands. And so there's not a lot of money that is still there to get out. And so it holds up surprisingly well. I mean, who would have thought, okay, the U.S. attacks Iran, we have the biggest energy shortage in the world, and Bitcoin outperforms gold for a month.
Now, to everyone's surprise, they say, God, we didn't realize a third of the world's fertilizer comes through the strait. 20% of the oil, I think about 50% of the helium, we have a huge amount of aluminum, all kinds of other things coming through there. So it is, from an economic point of view, very significant. Now, whether the value, my guess is, and this is without, doing due diligence, my guess is your assertion is probably correct. It's probably a lot more value goes through the Strait of Hormuz than the Bosphorus. But still, the the Bosphorus is not a trivial, and the Black Sea is not a trivial body of water. Believe me, I think it's a obvious one that China is benefiting from. This is a cost that the U.S. that Trump never thought about, and that is he's handed huge benefits to China, huge, massive, and in the geopolitical game. One great power is going to become weaker because of the war. That's the United States. And one great power is going to become stronger. That's China. And by the way, the third great power, Russia, is going to become stronger too. So from a geopolitical point, it was a bad calculus. And the reason that it was a bad benefit cost calculus is because I don't think the president made any calculus. I do think there was a delusional aspect. This is not logical. Any logical person would have never done this. You make an enemy. If I impose a cost on you, I'm not your friend. And what do you have? You have already pivoting away from the United States big time. Indonesia, the president of Indonesia, Prabowo, who is an old friend of mine because, as you know, I was President Suharto's chief advisor during the Asian financial crisis in 1998. So Prabowo, he's come out and said, fortunately, Putin is playing a positive role in this whole affair because he's supplying us with oil and gas. And by the way, the Russians end up being big winners. They're not only selling oil at high prices, they're actually not selling them at discounts anymore. They're actually getting a premium. They're selling them at a premium price. And so you have Indonesia, South Korea, Japan, Philippines, India. All of those countries have been under the gun with the United States, so to speak. Costs have been imposed on them, and now they're pivoting away. So they become, shall we say, I'll say it diplomatically, they become less friendly to the United States than they were. So there are all sorts of entanglements. The defense agreement is one thing, but it's the finance. The U.S. is the largest liquid capital market in the world. Where are you going to go? Switzerland? Well, a lot of people are going to Switzerland. It would obviously get a lot worse. Exactly how much worse, I don't know, but it would go from bad to very, very bad. And we probably would see those numbers drop down. The World Economic Outlook came out with the IMF last week, and they dropped the growth rate down from world growth down from 3.4 to 3.1, given the current situation. But that number, if it would continue, the war really would continue. My guess is that number would go pretty close to zero or maybe even negative. It would just be a cataclysmic thing that would happen. But looking at maybe how to get out of it, I think the way everyone's going to have to swallow this, if there's some kind of agreement with the Iranians, there'll have to be something like an international conference, to something like the Montreux Convention of 1936 that settled the Dardanelles and allowed Turkey to have essentially the sovereign rights over the Bosphorus and the Dardanelles, and Turkey manages it. So what that would be, I think, the ideal solution. Iran would end, the war would stop, and there would be a convention to deal with the Strait, and Iran would end up with the management responsibilities.
What makes this discussion so important is that it connects three major forces at once: precious metals, energy economics, and the future of the dollar system. When debt levels rise and central banks remain trapped between inflation and slowdown risk, investors start looking for assets outside traditional paper promises. If gold breaks into a sustained new range, predictions of much higher long-term prices could pull fresh institutional demand into the market. In that scenario, selected miners may still outperform, especially those with quality reserves and efficient operations. But if gold only moves sideways while costs rise, returns could become far more uneven. Steve Hanke's inflation discipline and Lyn Alden's liquidity framework both point toward the same reality. Monetary systems work until stress exposes their weaknesses. Stablecoins and digital dollar demand may temporarily strengthen the dollar's reach, but they do not erase structural debt concerns. That is why many investors are watching gold not just as a commodity, but as a signal. If it keeps advancing despite higher rates and volatility, it may be warning that confidence in fiat systems is slowly changing. The years ahead could reward patience, diversification, and ownership of real assets. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.